This is Terrence Andre Banks coming to you from Information Age Financial Solutions, talking today about hard money lending, real estate flipping, and what you need to be concerned about, especially when you're going to utilize a hard money lender. Now, I've probably touched on this briefly in another video that I've done before about some flaws about being careful about real estate because we're reaching the market cycle peak. But I really wanted to go more dive in depth with hard money lenders. Now, if you're not familiar with hard money lenders are a source of financing when your credit is challenged or you just need quick money to purchase a property, and you don't want to go through the usual criteria that banks have in terms of the lending criteria in terms of that. So hard money lenders have filled that space in providing you a quick platform you can use money to either rehab loans or even use it for do a transition quick, just holding for a short period of time and while you get refinancing in place. The thing that hard money lenders are mostly known for is just their quickness and speed. But many people, many investors are not aware of the hidden cost and the points that's attached to taking on the loan itself. And with so many hard money lenders competing in a space with interest rates going down and just on normal terms, and we're dealing, I'm not going to go into too much details of where we're at in the economy, but just think of this. Outside the United States, there's countries that's doing negative interest rates, which is putting more pressure in general on lenders in general terms of how they're going to be able to lend and how much they're going to be able to get a yield. So hard money lenders are competing with themselves, and some of them even going to forums saying that, hey, I'll even give you 0% down, and I'll pay for different aspects just to get people in the door for part of a marketing aspect. The thing, again, is the deferred finance charges, aka also known as points, and the other hidden charges they go in. When something seems too good to be true, it truly isn't. Now, this does not say anything that you should not use hard money lenders. I'm just letting you be aware, and there's a warning when you utilize them because those deferred finance charges, aka points, kick in immediately. So let's give an example here of what I mean. Let's say a lender says, a hard money lender says, I'm going to give you 10%. Sounds 10% of hard money for 9 months. And you're saying, great. And then he says, I'm going to give you a daily charge of $15. So that daily charge $15, that's nothing. But typically, if you're doing a rehab, the project's going to take a lot longer. And that deferred finance charge, that daily charges continue to accrue every day. So not in addition to you paying your normal interest rate payment of, let's say, I just said 10%, you also have those deferred finance charges, which could kick in, and those points could be another 5 to 6%, or even as high as 10 percentage points later that has to be paid at the balloon date of the loan. Many investors, many contractors that they're doing using hard money lenders are not aware of those deferred finance charge, I'm sorry, and they kill your deals. So I just want to do a video just strictly about them because the deferred finance charge and using hard money lenders, it just goes out of the doors and out of the heads of most people who are actually investing. Points is also known as deferred finance charges. They're interchangeable. Same thing, just a different term. They can kill your deal, and you need to be mindful of them. They kick in each and every day. Not only that, there's also upcharges that could go in for anything. For an inspection, there's a charge there. Wire fees, there's a charge there. There's if they have to send something FedEx, there's a charge there. Just know that every lender is trying to find a little way to get some extra money, especially if they have to lower their interest rates because they're competing to get you in the door, and they're going to find a way to get that same yield that they were looking at before when they were able to charge 15, 17% up front. They're finding other ways to do that in their deferred finance charges. They've always been around, but with so many people competing in this space, especially for lenders, because technically saying anyone with a 401k who has money to lend, I've been investing meetings where I'm seeing guys who have money sitting in a 401k and wants a better return. So they have access to credit and they start getting into real estate because that finds a way for them to get a better yield, and they may have a basis of that. A lot of contractors utilize hard money lenders. A lot of people who are really in space are not, who have credit challenges, use hard money lenders. Or it could be anybody just using a hard money lender because they just need the fast easiness of utilizing them, and Again, their biggest selling point is that there's no credit check. We make it asset based. Asset based means it's just based on the property or project itself. So just wanted to touch bases about that so you really know what you're getting into and really focus on knowing what those deferred finance charges are up front so you can have a clear mindset when you're going into that deal. And you have to take in consideration that, because every time you open up a wall, every time you do anything that requires a rehab, there's always going to be more lengths of time. It's going to be more cost, and essentially there's going to be more charges for you on the back end to be paid. So if this video has been any value to you, please subscribe, leave some comments, hit that button there, just the bell there, just to get you aware of any new videos that I'm doing. And until my next video, I'm out.